Welcome, everyone. Henry Wheelwright, managing partner and co-founder of Stablepoint Partners, checking in with our clients, of course, our general audience. It is the week after Labor Day. We hope everyone had a spectacular summer. I had a few days at the beach. Kids were at camps, and I must say, in my family, happy to see the kids back in school. We had a very busy summer as it related to the markets, lots of information to digest, terrific earnings, a lot of policies coming out of Washington. And this is shaped up, at least as we head into September, as to one of the stronger years for investors, both in the equity markets and bond markets, something that I've been talking about with the team throughout the year. We've been bullish, and thus far the numbers have really shown up. This week, I want to talk about really the three most important items that the market is going to be focused on, in my opinion, as we head to the end of the year. Number one is going to be jobs. We saw a non-farm number today that was a little weaker than expected, that has really continued the narrative that Jerome Powell and the Fed has talked about. Perhaps the labor market is slowing down. The second key ingredient is going to be the Fed itself. We have the big meeting coming September 16th and 17th. The market is now 100% expecting that this will be the pivot point in which the Fed cuts rates at least a quarter point, and begins to support the labor market, try to support the economy as opposed to fighting inflation, CPI, a lot of the items that have come out of the Fed and Jerome Powell over the last couple of years. The third element is really going to be the economy itself and earnings. We have seen a terrific run in earnings the last 3 quarters, something that has been quite remarkable and has really started this push and pull of, hey, is it a valuation story or stocks too expensive? Or are we in a real exciting period in which we can count on above average earnings growth? So let's go to number one, the job market. Tomorrow we're going to get an unemployment jobs reading that I think is critical. It's really critical because we want to see if we've seen some exceptions in the recent labor revisions, or in fact, we're heading into more of a normal cycle. And if you look at the charts, we've seen about 35,000 jobs per month added. That compares to about 130,000 a year prior in 2024. We've also seen a slowdown in wage growth. We've also seen for the first time a pivot point as we look at our unemployment filings, more Americans actually looking for jobs than jobs available. So I think last month's commentary out of Jackson Hole from the Fed chair was spot on. The labor market is slowing. I wouldn't necessarily say it's pointing to recession or areas that would be a huge concern, but certainly have provided the academic merit to consider to try to support the economy and cut rates. So tomorrow's reading along with today's reading, I think, are going to be supportive to what we see in September 16th and 17th. Jerome Powell is going to be front and center. Markets are going to be watching, do we get the Fed rate cut? I have talked a lot with clients that I think the markets have the ability to go higher. But as we think about our approach here at Stablepoint Partners, leadership and breadth is going to begin to change. We've started to see a very healthy environment this last quarter that's supportive of a bull market that can go higher, where we have a larger group of companies in the S&P 500, reaching new heights. And it's not just a technology or magnificent seven market. We're starting to see outperformance in a number of areas, financials picking up the slack, certainly industrials have been leaders along the way. And we came through an earnings cycle that's been remarkably strong. We've seen 11.9% year-over-year earnings growth in the S&P 500 for this quarter. That's on the back of 2 previous quarters of double-digit earnings growth. And let me remind you, the market works on expectations, certainly forward guidance. The expectations coming into this year were to be somewhere around 4.8%, maybe 5% earnings growth in the S&P 500. If you start to see a cycle where you get double-digit earnings growth for continued quarters, rather, I think it's really supportive of the market going higher. I want to talk a bit about policy. We have had a busy time where Washington, President Trump, the Fed governors like Lisa Cook have all been in the news daily. I'm not sure necessarily if that plays into the day-to-day activity, but we have seen 2 critical events that have pushed the 30-year Treasury above 5% for the first time from April and May. a lower court ruling that puts President Trump's ability to work off the 1977 Economic International Act to be supportive of applying tariffs put in question. That may flow up to the Supreme Court. We've seen the market begin to look at the tariff revenue that's come in. We look at the chart. We've had a significant amount of tariff revenue, 30 billion alone in August, coming into the US government, supportive of our expanding deficit. That number has more than doubled and may approach somewhere around 100 billion to 200 billion in 2025. So if you look at this week, rates went up, questioning President Trump's long-term ability to impose tariffs. We have a big Fed hearing coming up the 16th and 17th, and labor numbers coming out tomorrow. So big story of the week is interest rates. Guidance is stay diversified, dividend stocks, value stocks, select growth companies at reasonable prices. And of course, here at Stablepoint Partners, we rely on the motto, let your financial plan and the 4 CFPs drive what investment allocation makes most sense for you to reach your goals. Last note, speaking specifically to the clients and guests, our Vision event is coming in October 29th at beautiful Granite Links. Another tremendous event with wonderful speakers. Really look forward to showcase the intellectual capital and resources of our independent firm. We look forward to seeing you. Look forward to seeing you in the office for your reviews. Appreciate your ongoing trust and confidence.